Welcome back to the Canadian Retirement Roadmap. I'm your host, Patrick Briscoe, Certified Financial Planner. Today's episode is a quick but important check-in on the markets, what happened during the first half of 2025, and what we might expect heading into the third quarter. Let's dive right in. The first half of 2025 brought with it its fair share of drama. January began with markets pushing higher, riding the momentum from 2024's strong finish, mostly due to the new U.S. administration's business-friendly posture and AI tailwinds. But the optimism was pretty short-lived. By March, markets were hit hard by geopolitical tensions, especially those stemming from the Middle East, and continued uncertainty around U.S. monetary policy and its tariff tantrum. So investors got spooked. The volatility surged, and that culminated in what many refer to as Liberation Day. And that was a key market turning point in early April. Now, from that low, equity markets have rebounded sharply. And this emphasizes a risk that we often don't discuss, and that's upside risk. And upside risk is the risk of markets going up quickly when we don't really feel like they should. And timid investors who may be bailed after the initial downturn or were sitting in cash missed this quick increase in value from mid-April until today. So those who try to time the market not only face the possible downside risk, but also this upside risk. And that's why staying invested during these periods is so important and why it has paid off for you. So by the end of June, most broad equity markets had recovered across the globe. But that recovery varied pretty significantly from region to region. This next point is something I really want to highlight because it proves that the portfolio management style that we use is paying off. You'll see how diversification has truly paid off so far this year. The S&P 500, which is represented in blue and is an index of roughly the 500 largest companies in the United States, experienced steeper losses early on. Meanwhile, other markets like the MSCI EAFE in light green, and that represents international developed markets, has outperformed, especially since the April lows. So this demonstrates why a globally diversified portfolio can cushion volatility and create a smoother investment experience, especially if combined with fixed income and alternatives. So having all of these things together creates a much smoother ride. Clients who owned a well-diversified mix were better protected during the downturn and had more consistent returns as things started to rebound. So in addition to portfolio composition, behavior is very, very important. And this is a part that I'm really proud of. And so to you, our clients, thank you for staying the course. It hasn't been easy. Volatility tests our patience, and every headline tempts us to make short-term decisions, but staying the course during this period has really paid off. As the chart I'm showing now illustrates, and this is one that I shared in a recent newsletter, your behavior is the single biggest driver of long-term returns. You could have the best portfolio ever designed, but if you panic and sell at the wrong time, even if that's just once per decade, it can derail years of smart planning, and you can end up having less returns than that portfolio would have had you stayed the course. And that's actually the result for most investors. Most investors, on average, underperform the performance of their own portfolio, which seems very strange, but it is an industry statistic that I go back to whenever we think about making a change, because often that change is not the right move. Better to stay the course with the portfolio that we've designed for your needs and risk tolerance. As I said in the newsletter, portfolio design only matters to the degree that it influences your behavior. If we don't have the right portfolio, that's where we can sometimes get a little bit too nervous about where things are going. So next time any hand-wavy talking head on a financial network or YouTube these days urges you to buy, sell, or take action, just remind yourself, none of that matters if you don't behave. So you've done great. Keep it up. So what's on the horizon for the third quarter? Here's a quick summary of what we're watching and what our analyst partners are saying for the months ahead. Geopolitical risks remain, but easing trade tensions have reduced the chances of what we would see as being a major downside shock to the market. The US economy is slowing, but it's not in free fall. In fact, certain sectors continue to show a lot of resilience. And just as a reminder, the economy is not the same as the stock market, and they often move very out of sync. So what we see in the real world doesn't always translate to what the stock market is doing. So always just keep that in mind. Here in Canada, short-term headwinds do persist, especially in housing and consumer spending. Budgets are tight, households are feeling the pinch, and it doesn't look like we're going to get the interest rate relief as quickly and as much as we were expecting. But trade stability and fiscal policy will hopefully help in the months ahead. When it comes to China, they may introduce some targeted stimulus if needed to support growth, so injecting funds or activity into their market to keep it going. While Germany has already announced fiscal measures that should bolster the economy. So countries are working to continue to have their economies do well. So in short, the road ahead isn't perfectly smooth, but it's also not filled with potholes. As always, if we stay invested, patient, and focused on the long term, even during the most uncertain of times, it's paid off and likely is to continue paying off for us. Thank you for tuning in to this mid-year recap. If you're curious how your portfolio is positioned heading into Q3, or you just want to review your plan, please don't hesitate to reach out. As always, you can find helpful guides and past episodes at bayswaterwealth.ca/podcast. Take care, and I'll talk to you soon.
Trademarks owned by Investment Planning Council Incorporated and licensed to its subsidiary corporations. Investment Planning Council is a fully integrated wealth management company. Mutual funds available through IPC Investment Corporation and IPC Securities Corporation. Securities available through IPC Securities Corporation, a member of the Canadian Investor Protection Fund. Insurance products available through Patrick Briscoe. Independent of his role with IPCIC, Patrick Briscoe is also a co-author in the forthcoming books, entitled Financial Success for Pre-Retirees and Financial Success for Retirees, due out in early 2025.